Hey there, good morning. Welcome to Coffee with Connie. I'm Connie Foote with Foote Title Group, where we protect your home ownership. Hope everybody's having a wonderful start to your day, this a wonderful Thursday morning. I always look forward to coming and talking to you about all things real estate. I am not a real estate agent. I am a title company owner. We do home closings and we protect home ownership. And I talk to you about all things real estate, not because I know everything about real estate, but because I have been in this industry for a really long time and I've seen all kinds of things. And sometimes I just want you to think about things that may come up, questions you may have that I don't necessarily know all the answers to, but if you realize that other people have similar questions and it doesn't, and it's your first time maybe doing a real estate transaction, maybe it doesn't feel like a dumb question or something confusing. So I want to spur those questions for you, and I want you to feel comfortable reaching out. Reach out to me and we can put you in touch with a professional that has that expertise in that particular area. That's what we love to do, is give you information and value so that you can make better decisions, or at least ask the right questions. So hope you're having a great start to your day today. This morning I wanted to talk about mortgages, these fantastic interest rates that have been going on. You know, I like it when you guys ask questions and we experience things, because those experiences allow me to understand what questions are out in the market, so I know what kind of things to talk about to help you have a better experience. So one thing that recently came up is, as the interest rates are going up, you know, everybody says, well, gosh, after the elections, the interest rates are going up, and oh my gosh, that's going to make it so I can't afford to buy a piece of property. Or maybe somebody's not going to want to be able to buy my home because they don't have the ability to get these great interest rates. So one of the questions that came up recently in our office was particularly that. So if somebody is buying a piece of property and the interest rates maybe aren't that favorable, but maybe the person you're buying from has a really favorable interest rate, some mortgages that are, excuse me, that are out there are actually what they call assumable. And, you know, it used to be really popular to do, to purchase a piece of property from someone else or a home from someone else and assume or take over their mortgage. But that hasn't been real common, probably in the last, I don't even know, maybe even 20 years, because interest rates over that time, for the most part, have slowly declined, and so then making it more attractive for people to go out and take out their own mortgage and not have to try to take over someone else's mortgage. So let's talk about this whole assuming a mortgage thing and what that actually means. And again, I'm not a mortgage professional, so I'm going to tell you from my experiences and things I've seen, and so it may be a question to ask your mortgage professional. What does that mean, and how do I do that if the house that you're purchasing maybe has a mortgage with a great interest rate and the seller's willing to do that? So when we talk about taking over someone's mortgage or assuming that mortgage, we're talking about you coming in, buying that piece of property, and stepping in the shoes of that seller in their mortgage. That mortgage still stays intact. You don't go get a new mortgage. That mortgage that is against that piece of property now stays intact. Now, it used to be that you could do a simple assumption. I mean, basically you signed a couple pieces of paper and boom, you were now the mortgage holder, and the seller walked away and everything was fine. Well, of course, mortgage companies realized, hey, that's not the best idea for us, because there is a lot of liability if we don't check out the new purchaser. So now more often we see the mortgage company that holds the mortgage, if the mortgage is assumable, if you can take it over, and we'll talk about that in a second, but that mortgage company is going to require you to sign some paperwork, go through a credit check, go through a lot of the similar things you would go through if you were getting a new mortgage yourself. But the difference is the mortgage already exists on the house, so the house no longer is in question. A lot of the certifications and inspections that the lender would normally require on the house no longer are expected, because they already know about that house. Hey there, Ashley. How are you this morning? Thanks for tuning in. So if you're going to take over somebody else's mortgage or assume it, then typically that mortgage company wants to find out about you, because they want to make sure you qualify for that mortgage. Now, if they go through some of those steps, it depends on the type of mortgage and the requirements from the mortgage company, but they may allow you to take over that mortgage, and when they do, then that seller is no longer has any liability or responsibility for that mortgage. And in some cases that's true, and in some cases that's not. So let's talk about that for a minute. If you're doing a government-backed mortgage, FHA mortgage, or some of these other types of different government-backed mortgages that are available out there, they may have the ability for you to step in the shoes of the seller, take over that mortgage, and take over that seller's responsibility. So the seller walks away as if you had gotten your own mortgage, and they have no longer any responsibility. And it allows you to capture some of these great interest rates that people were able to get, 3%, 3.5%, gosh knows, who knows what they're all about. But the interest rates as they increase, this gives you the ability to potentially capture a really good interest rate. Now, let's talk about if you're a veteran and you're selling your home and you have a great VA interest rate and somebody wants to buy it and take over that mortgage. Well, let's talk about that for a minute. So your VA eligibility is tied up with that mortgage. So if someone comes in and takes over that mortgage and they are not a veteran, then they could potentially assume your mortgage or take over that mortgage, but your VA is still going to be tied up. So they may take responsibility of the mortgage, but your VA is going to be still tied up, and you're not going to be able to go use it on something else. If the person taking over that mortgage from you is a veteran and their eligibility is available, then they may be able to substitute their eligibility for yours, and again, it would be as if they had gotten their own mortgage. So it's something to think about, something to be talking about. Your realtor can help you. If you have a mortgage professional that you've worked with, these are people that have those pieces, those critical pieces about the specific scenario you're in. As I said, like to talk to you about some of these things because there are possibilities and availabilities in the market, especially with these interest rates that were so good over the past couple of years, and now they're going up a little bit. So it'll give you some flexibility and potentially a different way to potentially sell your home. You want to get out of your home really quick because maybe you have a great opportunity for a job that's a couple of states away or across the country, or maybe you have you really need to downsize because you've had a family situation, so you need to get out of your house. It gives you a real good sale potential if you have this great interest rate and your mortgage is assumable. If you're a seller, you need to contact your mortgage company and have these questions with them. So when you go to put it on the market, you can actually offer that as a potential way to sell the property and potentially make you very appealing to a lot of people that are in the market that maybe don't qualify for a 5 or 6 or 7% interest rate. Maybe they do qualify for a 3% interest rate, and now all of a sudden, voila, your house is much more appealing, and maybe they love it, and now they can afford to buy it. So as a seller, if you have some of these situations, you want to get out there right now and call your mortgage company and start having these questions and find out what the rules are, what has to happen. Do I need to do some things beforehand? And then when you find those answers out, then you can talk to your real estate professional and say, hey, guess what? I have this ability to be able to sell my home this way, and I want you to market it that way because this is another way someone could buy a home, and it makes my home a lot more attractive to potential purchasers because there may be some people in the market that otherwise couldn't have afforded it. So, hey there, Roy. How are you this morning? So as I said, I don't know all the answers about real estate. We've been working in this community, in this industry for a very long time. And so a lot of these things have come around and we've seen them and we've been exposed to a lot of the information. We've worked with a lot of the mortgage professionals and realtors in the Maryland and Virginia community. And so we understand these things. This particular broadcast is not specific to Maryland and Virginia. This is anywhere in the country. This could be potential for you. So it's definitely something that you need to think about. And if it's something that you know, maybe somebody you know is selling a piece of property and this is something that potentially they could think about, please share the broadcast because you never know what somebody else doesn't know, and you may be able to help them be able to make their sale a little more attractive. Or somebody buying a house that really wants to buy a home that is available, maybe that opportunity is available as well. And as the buyer, it may be a question to ask your realtor to go to the seller and ask for that opportunity. So hopefully that helps a lot. And hopefully Sarasota, yeah, anywhere. I think if you're asking me, right, Sarasota, is that somewhere that it could work? Yeah, absolutely. This is definitely something if somebody is purchasing in another area and that mortgage has that low interest rate, absolutely. That's something that could happen anywhere across the country. It's really the rules with the mortgage company that is holding the mortgage right now about what they're going to require to let someone assume that mortgage. So hopefully I've helped you a little bit today. Maybe spurred a question, maybe made you think about somebody you know who's looking to sell their house, and maybe they're in a situation that they need to get out and you want to share the information with them. Maybe you have some questions about it. Maybe it now makes you a little more eligible to buy something that you weren't aware of. So it's always my goal to give you as much information as possible, and when something comes across our office that somebody's asked a question about, I'm happy to jump in and try to help and answer those questions. And I love sharing it on a live broadcast because that means there's somebody out there that has that question, and probably several people do. So hopefully I helped you this morning. I hope you guys have a wonderful end to your week, super successful. Please reach out and ask me if you have any questions with real estate, and I can either hopefully answer or put you in the right direction to get you the right answers. So as I've told you before, there's lots of resources on our website. We've talked about protecting your home ownership a lot, and this month we are totally focusing on a piece of literature we have on there that you can download. It's called 73 Ways You Could Lose Your Home. Very, very valuable piece of information that are about things that you just cannot even imagine. Basic, simple things that happen all the time. So get on there and download that. If you're a realtor or lender or a buyer or seller and you want to just calculate some costs, you want to understand what's going on, there's a cost calculator on our website. That's right on the front page. You do have to register for it, but it does not put you in any email spam or anything else. It just allows you to save your quote so you can go in there and make some calculations on quotes. And finally, I just wanted to point out, if you're doing a closing in Maryland or Virginia, you do not have to come to our office for closing. We do travel to you for closing, and that's in Maryland and Virginia. So please let us know how we can help you out. I'm Connie Foote with Foote Title Group, where we protect your home ownership. You guys have an awesome day, and I'll talk to you soon. Bye-bye.